Back in early 2026, when the S&P 500 finally smashed through 7,000, it didn't feel like a milestone. It felt like a trap. And in this breakdown, we're going to walk through all the hidden signals, piece by piece, that were screaming a major correction was coming.
So, picture the scene. It was pure, absolute euphoria. Every financial news channel was going crazy. You had headlines screaming about a new paradigm, and it just felt like the party was never going to stop. I mean, the index had blown past 6,000 just 14 months before. This rocket ship just seemed to confirm one thing for everybody. We were in a totally unstoppable bull market. And there it is, 7,000. Such a huge, round, psychological number. And for so many people, this was the ultimate confirmation. It was the sign that, yep, everything is great and stocks only go up. But here's the thing. Behind the curtain, the big institutional money, they were already quietly heading for the exits. And that is the million-dollar question, isn't it? That's what this whole thing is about. Because almost as soon as it hit that peak, poof, the momentum just vanished. And it wasn't some random dip. It was a deep structural shift. So let's put on our detective hats and look at the evidence that was hiding in plain sight the whole time. Okay, first things first, we have to look at the very structure of the rally itself. On the surface, yeah, it looked incredibly strong. But when you start to dig just a little bit deeper, you find a foundation that was built on sand, not on solid rock. So to really get why 2026 was so weak, we actually have to rewind back to April of 2025. There was this surprise tariff announcement, and it caused this sharp, nearly 20% correction, a real market tantrum. But then, the market just rocketed back in this insane 36% V-shaped recovery. Now that felt great, right? Super bullish. But a move that vertical, that fast, creates a really fragile structure. There's no healthy sideways action, no consolidation. It's kind of like trying to build a skyscraper on a foundation of wet cement. The market was literally borrowing returns from the future to pay for that panic in 2025, and the bill was about to come due. And that structurally weak rally, it led to this really dangerous condition called multiple expansion. It's a key concept to get your head around. It just means the market wasn't going up because company profits were exploding. Nope. It was going up because people were willing to pay a crazier and crazier price for every single dollar of those profits. Which brings us to this number. This one right here should have been a massive flashing red light for everybody. At its peak, the S&P 500 was trading at 22.2 times its forward earnings. Now that number, all by itself, is pretty high. But when you add some context, it becomes downright terrifying. And this chart just shows you how incredibly stretched we were. At 22.2 times forward earnings, we were way beyond the historical averages. The market had basically priced in absolute perfection, leaving zero, and I mean zero, margin for error. The only surprise left was to the downside. Okay, let's move on to our second pile of evidence. Now we're going to look under the hood of the index itself. Because while the speedometer on the dashboard said we were flying, the engine was starting to seriously misfire. And that brings us to something called the Hindenburg Omen. I know, it sounds spooky, and there's a good reason for that. It's a really rare signal that only fires when the market is deeply, deeply fractured on the inside. Think of it like an MRI that reveals a hidden tumor. So here's how it works, and this is the crucial part. The Hindenburg Omen triggers when you have a whole bunch of stocks hitting new 52-week highs at the exact same time as a whole bunch of other stocks are hitting new 52-week lows. It's the definition of a split personality market. It's like a civil war is happening right under the surface of the index price. The generals are charging forward, but the soldiers are in full retreat. And believe me, the warnings were not subtle. The Omen fired in October 2025. Then it fired again on January 29th, 2026, just as the market was making that final euphoric push to 7,000. The check engine light was flashing bright red, but everyone was just too busy staring at the speedometer to even notice. I mean, this chart just shows you how broken the market really was. By late 2025, the entire rally, the whole thing, was being propped up by just two stocks, NVIDIA and Alphabet. You see that? The other 498 stocks in the S&P 500 were basically getting left in the dust. When a market gets this narrow, it's not a bull market anymore. It's a house of cards just waiting for a breeze. All right, for our third piece of evidence, let's move away from the technical charts and into psychology. We need to understand what the smart money was thinking and how the fundamental story that drove this whole rally was starting to fall apart. And to do that, we can look at something called the NAIM Exposure Index. Now, this isn't about what some talking head on TV is saying. This is about where people are actually putting their money. It measures how invested the pro fund managers are in the market at any given time. So in January 2026, this index hit the 96th percentile. What does that mean? It means active managers were basically all in. They were leveraged to the hilt, maximum long exposure to stocks. And you might think, wow, that's super bullish. But it's actually a massive, massive contrarian red flag. This quote just captures the logic perfectly. Markets need fresh buyers to keep going up. When sentiment gets this extreme, it means all the buying power has been used up. There's no one left to sell to at a higher price. The only move left for these managers was to start taking profits, which is exactly what happened. And right at the same time, the fundamental narrative around AI was shifting under everyone's feet. See, in 2025, the story was all about building the future. Big tech spent a staggering $405 billion on Capex, and investors loved it. They rewarded them for it. But by 2026, patience had run out. The question suddenly changed from who is building AI to, okay, who's actually making money from AI? Investors started demanding to see a return on all that investment. And the monetization, well, it was proving to be a lot slower than the spending. The market had priced in 2030's reality for 2026. Now let's pull the lens back even further, because this whole episode wasn't some unique black swan event that no one could see coming. It was actually part of a really predictable pattern, an echo of a major market peak from our past. What's really wild is the uncanny parallel to the dot-com bubble peak. It looks like there's this 26-year cycle. Back in 1999, the catalyst was the internet, and the psychology was euphoria. Fast forward to 2025, the catalyst was AI, and the psychology, you guessed it, euphoria. The chart patterns, the parabolic run-up, the narrative, it was all rhyming. This suggested the market wasn't just overvalued, it was following a historical script for a major reversal. And if that wasn't enough, you had the political calendar working against us. 2026 was a midterm election year, and historically, these years are just brutal for stocks. We're talking an average intra-year drop of about 18%. The market absolutely hates uncertainty, and midterms bring maximum uncertainty in the second and third quarters. This seasonal factor created a predictable volatility window that the market walked right into. So with all this evidence laid out, the trap becomes crystal clear. But the story doesn't end there. Understanding the trap is just the first step. The next step is positioning yourself for the opportunity that this kind of big correction always creates. So here's the crucial point. This kind of correction isn't the end of the world. It's a necessary reset. For the investor who's prepared, the playbook is pretty simple. First, you just have to survive the washout as all the weak hands get shaken out. Second, you have to wait patiently for true capitulation. Don't try to be a hero and catch a falling knife. And third, you prepare for the next big phase, a market rotation. Because what comes next is the big shift, from the builders of AI to the users of AI. The productivity gains will finally start to flow into the rest of the economy. We're talking energy, materials, healthcare. The winners of 2027 won't be the companies that sold the shovels during the gold rush. They'll be the ones that actually used those shovels to find gold. So the question is, now that we understand the trap, are we ready to ride the next wave?